Welcome to Paisa Pathshala. If you are just starting your career, the world of investing can feel like a maze of apps, tips, and confusing jargon. Today, we are simplifying it. We are talking about the 3-fund portfolio, a strategy that is perfect for beginners who want to grow their money without spending hours every day watching market charts. What exactly is a 3-fund portfolio? Simply put, it is a diversified strategy that uses just 3 types of mutual funds to cover almost everything you need. Instead of picking individual stocks like Reliance or TCS, you buy buckets of investments that hold hundreds of companies at once. It is low maintenance, low cost, and very effective. The first bucket is an index fund that tracks the Nifty 50. This gives you exposure to the 50 largest companies in India. When you buy this, you own a tiny piece of India's biggest banks, IT giants, and consumer brands. It is the core of your portfolio because it captures the growth of the overall Indian economy. The second bucket is an international index fund. Why look outside India? Because you don't want all your eggs in one basket. By investing in a US-based fund, like one tracking the S&P 500 or Nasdaq 100, you get exposure to global tech giants like Apple, Google, and Microsoft. It helps protect your money if the Indian market has a rough year. The third bucket is for stability, a debt fund or a liquid fund. Think of this as your safety net. While stocks go up and down, debt funds invest in government bonds and corporate loans, which are generally much steadier. If the stock market crashes, this portion of your portfolio keeps you from panicking because it stays relatively flat. Now, how much do you put in each? This depends on your risk appetite. If you are 22 years old, you can afford more risk. You might choose 60% in Nifty 50, 20% in international funds, and 20% in debt funds. The goal is to set a target and stick to it, regardless of what the news says.
One of the best things about this strategy is the power of a SP, or systematic investment plan. You don't need a massive lump sum to start. You can start with as little as 500 rupees a month. By investing a fixed amount every month, you benefit from rupee cost averaging, which just means you buy more units when prices are low and fewer when prices are high. You might ask, what about direct versus regular plans? Always choose the direct plan of any mutual fund. Direct plans have a lower expense ratio because you aren't paying a middleman or a broker. Over 10 or 20 years, those small savings and fees add up to lakhs of rupees in extra returns. Check your investment app to ensure you selected direct.
What if the market drops 10%? Do you sell? Absolutely not. A 3-fund portfolio is built for the long term. When the market is down, your SIP continues to buy more units at a cheaper rate. This is when the real wealth building happens. Remember, time in the market is always better than timing the market.
Once a year, you do something called rebalancing. If your Nifty 50 fund grew so much that it now makes up 80% of your portfolio instead of your target 60, you sell a little bit and move that money into your debt fund. This forces you to sell high and buy low automatically without any emotional decision-making.
Start small, stay consistent, and keep your costs low. You don't need to be a financial genius to build wealth in India. By focusing on these 3 simple buckets, you are already ahead of most people who get distracted by hot stock tips on social media. Here is your actionable takeaway for today. Download a trusted investment platform, create your account, and set up your very first SIP in a Nifty 50 index fund for just 500 rupees. That single step is the most important one you will ever take. Thanks for watching Paisa Pathshala. See you in the next one.